This is TreppWire Week in Review for week ending February 18th, 2022. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Henry, Head of CRE and Advisory Services. This week, Russia-Ukraine tensions stole the spotlight, and Fed minutes didn't seem to spook investors much. In economic news, a lot of fresh data. Retail sales rose last month, and wholesale inflation surged again. Jobless claims rose last week, but the 4-week average was lower. Mortgage rates increased, and fourth quarter hotel earnings underscored a continued recovery. Manus, there was a lot of data to digest this week. What stood out for you?
Well, the two big things, of course, one was inflation related, and the other was Russia-Ukraine concerns, right? The saber rattling that's going on and the heated rhetoric. I'll start off with the inflation side, and then we'll move into the geopolitical side of things. We saw the PPI number came in above estimates. When you looked at CNBC that morning, and Steve Leisman in particular, he was quite dour. He saw that number and he was alarmed by the number, as I think many people were. But when the markets opened, there was very little reaction. And it seems to be a little bit of the case that the first time you are hit with a negative number like we were with CPI a couple months ago, and then the second time and the third time, the markets really get rattled and things sell off. In this particular case, the markets really didn't sell off. It's almost like they've priced in high inflation for this foreseeable future, and they think it's okay. Part of that might be the fact that even though costs are going up, there hasn't been much of the way of consumer pushback or a consumer strike. Spending seems to be going along quite well, and that might explain the muted reaction to what we saw on the inflation number. Tied to the inflation number was the Fed minutes. I guess depending on where you sit, I guess is how you reacted to them. The Wall Street Journal came out and said the markets rallied after the minutes released because the Fed wasn't more hawkish than they were. They did talk about accelerating rate hikes, pushing up the curve, doing more rate hikes and so forth. And the markets reacted with a sigh of relief. That was the Wall Street Journal takeaway. My takeaway from reading them was more that people think inflation is a concern, and the Fed is now taking it seriously too, and they might finally wrestle inflation down to the ground. We'll see. It was a tomato type thing between what our perspective was in the Wall Street Journal. But that was the big headline, and I'll let you weigh in.
Yeah, I think it's interesting. Sometimes when I read the Fed minutes, I wonder if they just, forgot to change the date and supplied the previous minutes this time, because it seems like we've been talking about these same topics with the same strategy. We're going to, look at 2 rate increases as 25 basis points, as 50 basis points, and we're not really seeing any of the action yet. So I think to your point, like, people are pricing that in, they're anticipating there's going to be something. I think we're all at the point of just saying, like, what is it going to be? And let's get the party started. So nothing earth shattering there. I think we all know where we're at. The inflation narrative's not going away. We talked about that at length last week. I think it's good that it's top of mind. Hopefully we'll see some action from the Fed to maybe tamp that down some. But at this point, there wasn't anything in there that just jumped off the page at me that said, we need to be worried one way or the other.
So you're more on the side of the Wall Street Journal. You saw it as status quo and a sigh of relief. I guess maybe I was reading between the lines a little bit. It seemed to me when they said moving up the pace of the rate hikes, I took that to mean, a little bit more hawkish. They're going to move quicker than we thought, and that's a good thing in my estimation. But obviously, others took it the other way, and it sounds like you did as well.
Yeah, I think I agree with you. I think it would be a good thing if they would get about that business, right? The challenge is they've just been talking about it. Like, we need to see some action. So yeah, if they start moving the needle, I think that's a good thing for all the reasons we've outlined in the previous episodes. But to me, like, I think we've heard this enough. Like, we need to see some action, not just talking about it.
Yeah, as you say these things, it just reminds me of what my life is like at home, where at least if I were in my wife's mind right now, she would say, man, that guy Manus, it's all about, talk and no action, whether it's taking out the trash or emptying the dishwasher or painting the bathroom. It's all talk and nothing ever happens. And it's probably true. moving on to the geopolitical side, we're recording this on Thursday like we usually do. 4:30, the market has closed on Thursday. Heavy selling today. CNBC and others were chalking up that selling to new concerns that war in the Ukraine was imminent. We've seen this several times over the last couple of weeks when the markets sell off, where they think that push has finally come to shove and war is at hand. And so I'll start out with an early shout out, kind of a serious one. We tend to talk about everything in economic terms, and I'm as guilty as anyone of this. And I write about economic things every morning in our TreppWire and so forth. And it's very easy for me to kind of rattle off the tongue or rattle off the keyboard that the market sold off 1% or 2% because of war concerns in the Ukraine. But rarely do I take a step back and think that there are men and women who are going to be putting their lives at risk from three different countries, perhaps, maybe the United States, maybe people in NATO, so maybe more than three countries, the Ukraine and Russia. And I know for a fact that there are listeners here who have kids that are in the military and are wondering if their sons or daughters are going to be pulled into this thing. So I just wanted to do an early shout out for all those people that have nieces and nephews, sons and daughters that could be facing action in the Ukraine. It's easy to push this stuff off with a sentence or two in our TreppWire or in our commentary that the market sold off because war could be coming, but rarely do we mention the sacrifices that people make to defend this country and to defend their own countries and so forth, like in the Ukraine. So I just wanted to throw that out as an early shout out, and hopefully cooler heads will prevail.
Yeah, I agree with you, man. It's the people element. I've seen some of the pictures of people in the Ukraine training or preparing themselves for an invasion. And, you know, with three kids of my own, it's a scary thought that could happen for them. And so I appreciate you kind of taking that position today, because it is easy for us that cover the finance, economic news to kind of go through this at a higher level. But at the end of the day, I mean, there's a lot of people's lives at stake here. So I agree and echo the sentiment, and hopefully the cooler heads will prevail.
Manus and Lonnie, that is well said, and obviously dominating the headlines, because I think it's a big concern for many people, at least in the last week or so, and more so today. Let's turn some of our focus to the commercial real estate market.
I wanted to kick off this week with a lot of industrial stories. It was a big week for industrial deals, and for me, I spent some time this week looking at price comparisons, what things were being sold for, and just kind of really amazed by what people are paying for industrial. And I'll give a couple of stories, and then I'll give one hardcore anecdote to wrap it up, and we'll get Lonnie's thoughts as well. The first story I saw this comes from Natalie Kostelny of the Philadelphia Business Journal. She's certainly in my top 10 commercial real estate journalists that I follow, along with Brian Bandel, South Florida, and Danny Ecker and Abby Gallum in Chicago, and Alex Barrera out in the West Coast. All do a terrific job following real estate in their cities. She put out a piece this week that an Amazon leased industrial facility in Conshohocken, PA, sold for more than $800 per square foot. That's more than 2 times the previous record for the kind of Bucks County area of Pennsylvania. It's 120,000 square foot property. It sold for $97 million. So just blows away the last high watermark, which I think was under $400. You know, it's like $335 or something like that. In Southern California, the Commercial Observer was reporting that Rexford paid $170 million for 5 Southern California warehouses, 150,000 square feet, 436 per square foot. The seller was Atlas. Why this one got my attention is Rexford was paying more than double what Atlas paid in 2019. So in 2.5 years, we've seen the value of these 5 warehouses go from 29 million to 64 million. Similar story in Tampa. There, EQT Exeter paid almost $40 million for a property that's leased to Refresco Beverages. That's up from 16.5 million in 2019. That comes with a bit of a footnote because Refresco just re-upped their lease there for a long period of time. So there is actually cash flow change at that one. Investcorp bought a huge Class B, B plus warehouse portfolio for an average of $114 per square foot, 64 properties in Chicago, Dallas, New York City. I could go on and on and on about this, right? The number of record-breaking industrial sales is through the roof, and I could probably give you 10 more. But I wanted to focus on something that really caught my attention in Miami. So in Miami, in December, a pair of cold storage units totaling 320,000 square feet sold for $44 million. One is in Miami, and I think one is in Hialeah. These two properties sold independently, one in March of 2020. So after COVID began, and in July of 2020, well after COVID began, for 70% less than what they sold for in December. And put that in perspective, this isn't Amazon, right? This isn't Amazon coming in and completely changing the fabric of a warehouse or distribution center from something old economy to new. And you could say, wow, that justifies a 70% price hike. This is cold storage, right? And it was sold after COVID began. So you already knew people are going to need more cold storage now than ever before, right? They're going to need food delivered to their homes, into grocery stores. And yet this thing, one is leased to Super Value, the other to True Grade Foods, up 70% since the summer of 2020. And that just gives you a perspective of how crazy on fire this is, this market.
Yeah, man, it's the industrial market is definitely become the darling. It's I'll get my weekly Twitter mention out here. As you guys know, I'm kind of a lurker on the Twitterverse, and don't post much, but I like to read all of the commentary. And the narrative in the industrial space that I've seen online is it's an encumbrance to have a tenant with a lease in your property, because the reality is the market rent sometimes is 2x what the current tenant is paying. So unless you're leasing to Amazon in a build-to-suit scenario, or you're buying a property that's leased to Amazon that was just signed in the last year or two, if you have legacy tenants in place, you know, the recent rental rate boom in the industrial market, the upside is real. And, you know, people are underwriting deals, and by the time they actually get them acquired, the rents are even higher than what they underwrote. So we talk a lot about multifamily rent increases. We talk a lot about compression in the multifamily cap rate sector. The same can be said for industrial, and maybe even to your point, after looking at these stories today, in a more robust fashion. The industrial sector is on fire. It's been on fire since the pandemic. I think what's interesting, though, or what makes this interesting in the medium to longer term, is a lot of these are special use buildings. So the Amazons, the cold storages, you know, are the data centers, are those things going to be in such hot demand in 3, 5, 7 years? I mean, multifamily has some inherent benefits, but is the technological advances that makes Amazon cutting edge now going to still be in place in 10 years when these leases start to turn over? So, you know, we were looking at some of our Trepp data this week. So Trepp manages a bank balance sheet consortia. We have contributing banks that give us their loan information, and we anonymize it. And we've talked about it on the podcast before. It's called Taller, Trepp's anonymized loan level repository. I was going through some of that data this week, and if you look at Q3 21 industrial loan origination volume compared to the average industrial origination over 2019, we're like 233% in the third quarter of 21. So what that tells me is it's not just on the sales transaction side where we're seeing these huge upticks. The lenders like these properties. They're making, you know, broader loans, larger loans, geographically more diverse. You know, I think a contrarian approach to this might be, does this sector really have the juice in it to stay at these prices for the long term?
Well, that is exactly kind of where I was going, I guess, with that cold storage sale, right? Cold storage is not something that's new and sexy, right? It's been around for a long time. It's not the kind of thing, again, you brought this up in your comments as well. It's not converting old school to Amazon, right? This was cold storage 10 years ago. It's going to be cold storage 10 years from now. How do you justify a 70% increase in value for something that, you know, isn't really, you know, everything's in the details. Perhaps these particular properties are getting re-leased up, or the rents been renegotiated because a lease was ending or something like that. There's always that detail that a broker will know that maybe we don't. But that one just stood out for me, given the briefness in the run-up in time and the fact that this was not something new, custom built, or sexy in the market. So it just goes to show that the tentacles of this rally in industrial are very deep and very wide.
Yeah, I would agree. I think the supply chain maybe has an impact on that. So some of the disruptions we've seen with the supply chain maybe makes cold storage a safer play now than it did in the past. Like the unknowns, right, are being factored into some of those, typically, as you said, unsexy type of properties. So very interesting.
And we saw some big deals in some other property types as well. Which ones caught your attention?
Yeah, there's a couple in every single sector that we could talk about. We saw a story out in California. We were joking about that this about the office. If only every B and C mall had this exit option. The shops at Tanforan, if I'm pronouncing that correctly, in San Bruno, California, sold for $328 million. That's the sum of $95 million for the inline stores, $105 million for the JCPenney parcel, go figure, and $128 million for the Sears parcel, right? Most times you're seeing Macy's and Sears parcels at these older malls sell for $5 million, $3 million, $10 million, $128 million for Sears. Well, the backstory to that is the developer's going to come in there, plow it over, and turn it into a life science campus. It's too bad more B and C malls don't have that particular outlet to do that. A couple of other record-breaking stories. In Phoenix, the Roadrunner on McDowell, Yield Pro is saying that property went for $550,000 per unit, which is a new all-time high for the Scottsdale, Arizona market. They also say the total price of $193 million was the second highest dollar amount paid ever in Arizona for a multifamily property. And I should say that highest price ever per unit is not just for Scottsdale, for all of Arizona. In Westport, Connecticut, Stamford Advocate, which another local publication that does great work on the commercial real estate side of things, Alex Soul with his story, 95,000 square feet across 2 buildings on Riverside Avenue in Westport, Connecticut, sold for an average of $450 per square foot. The Feel organization paid Baywater $43 million for the assets, and it was said to be among the highest dollar amount per square foot in that area. So just a lot of really good news in the commercial real estate market for sellers of things. And, hopefully the cooling off of the economy as the Fed taps the brakes and so forth, maybe slows down the growth somewhat so that the party doesn't become too exuberant, but doesn't take away the punch bowl entirely, and sellers continue to get good values for their sales.
I think we need to talk to Martha and Haley Manis on getting us a breaking news sounder, but for every time we have a record price, because the last couple of weeks have been pretty incredible in terms of these per unit numbers that we're seeing. So I'm envisioning every time you go through a story, we get some sort of maybe it's the all right at the end of the podcast, and we just keep playing that every time there's a record price.
We could do that, or a cash register sound or something like that, just to jazz it up.
It's in our budget. We got it. We got this. So Lonnie, a few minutes ago, you were talking about our bank consortia data with the taller data. And interestingly, the Fed released its updated scenarios for 2022 for stress testing. So what are the takeaways from the updated hypothetical scenarios, Manis?
Well, I thought they were incredibly benign. That was my first reaction reading them. Although I'm kind of a tourist in stress testing, we do have some experts here that really follow this stuff in and out. Matt Anderson at Trepp being one of them, who is really the expert on how to interpret the new data. He has built top-down stress testing models for banks, which test their balance sheets under all different types of economic scenarios. And he has an amazing track record of identifying which banks, were going to fail. I think out of the 300 or so banks that failed during the great financial crisis, he identified 295 as likely to fail, and it turns out that they did. And he also helped build our bottom-up model for commercial real estate defaults under stress tests. And so I went to him to see what his reaction was, and he was of a like mind to what I was thinking, which is these are quite benign, and they hardly strike a chord. They're almost like a misnomer now to call them stress tests. In the severe case, the severely adverse case, unemployment goes up to 10%. Well, we already know that during COVID, unemployment went up to 20%. So this is not particularly stressful, other than the fact that in this stress test, it goes up to 10 and it kind of lingers there for a while. And it kind of more benign for me was that to stress your commercial real estate assets, they wanted every asset to endure a 40% cut in value, right? So if you had a $150 million loan, $200 million value, a 75 LTV, they would want to say, assume that 200 million goes down by 40%, right? So you're talking $120 million value. Once you get value that's negative equity, the likelihood of default goes up considerably, and that's the stress test that they have. My problem with this is that in many segments, values have gone up by more than 40%. Maybe not in 1 year, but certainly over 2 years. Things are up in multifamily, in industrial, in self-storage, in warehouses, distribution centers, fulfillment centers, not hotels for sure. So to say we want to assume a 40% discount to current values to stress these does not sound particularly stressful to me. It sounds like barely a reversion to the mean. And in that regard, if you're a bank, I think you probably feel like you dodged a bullet. This is benign. And if you're somebody who thinks the bank should be rigorously tested, this might be a little bit light for your tastes.
Yeah, I think you make some valid points on all of those things, Manus. I mean, I think some of this stuff is a little bit of headline fodder. Like if you read it without having any institutional knowledge or any knowledge of what stress testing truly means, like you may say 40%, wow, that seems pretty severe. But to your point, when it's 40% of a value that's increased 100% over the last 5 years, it's barely, doing a test. I mean, it reckons me back to an old Eminem lyric. When I think of stress testing, it's knees weak, palms are sweaty. There's vomit already on his sweater, mom's spaghetti. That's what I know about stress testing. I don't know anything about models or anything else. That's what we have Matt Anderson and Manus for, and a few others on our team. But 40% when something's gone up in value significantly, especially across these other asset classes. You look at self-storage, for example, senior housing, mobile home parks, like those things have seen astronomical increases on a relative basis over the last 5-year period or so.
Yeah, I'm just kind of scrolling through this data that I keep for myself. And, granted, some of the stuff I'm looking at, the last sale was 2016 or 2017, so it's a longer window of time. But kind of seat of the pants as I look for these valuation increases, I think the mean must be 60 or 70%, up. And I see tons that are triple digits. So, like I said, I think the stress test is quite benign, and I think it will. Banks have been passing these things with flying colors for a long time. They've built up their capital base, they've built up their reserves, and so forth. So I wasn't expecting any issues to begin with, but seeing these numbers, I think it'll be quite easy for banks to pass this thing. But having heard Lonnie rap a little bit there, I can't wait for the next Christmas party and getting him to the karaoke machine. That's on my bucket list now.
I'm not sure he
you
really
talked
rapped
about
it though. He just kind of like recited it. You might need to work on the rap angle of that, Lonnie. I don't know. Maybe you just don't rap in Texas.
Oh no, if I wasn't in CRE, I wanted to be a rapper when I grew up. So if you throw a little Drake on, I can do some Drake, and maybe that's not rapping. That's kind of pop rap, I guess, pop, R&B. But yeah, if Manus was talking about being a DJ earlier, I don't have DJ skills, but I can write some lyrics.
You can write.
Well, it's funny. Martha's kind of like equating Lonnie to that guy in Footloose, the sidekick to Kevin Bacon, who couldn't dance and had no rhythm. Like, is that what you're saying, Martha?
I didn't say that, but I think he's got to work on his rap style a little bit. So
wasn't Footloose, didn't that take place in Texas? Isn't that a place
Some
where you couldn't
state
dance.
where you're not allowed to dance. I don't know what state that is. Don't want to live there. Well, we talked a little bit about the write-up that Matt Anderson did, and I think we're releasing that next week. So if you're interested in that and you want kind of the detail behind some of the commentary we had today, give us a shout and we'll send that to you. And while we're on the topic of lenders, Lonnie, you went to the Mortgage Bankers Association event in the last week, where obviously lots of lenders show up to find out what's going on and what are the trends. So what were some of the big takeaways?
Yeah, so I'll say the MBA conference was pretty well attended. Unfortunately, the sunny San Diego moniker didn't play out, but in true MBA fashion, we had at least one day with kind of a constant drizzle and a little bit of a chill in the air. But on a relative basis, this conference was really well attended. There were a lot of people there. There was a lot of deals going on, hands being shook, pats on the back. They had a really nice lineup of some celebrities on the first night. Thurman Thomas was there signing autographs. They had Magic Johnson as the keynote. So, MBA puts on a really great conference, and this was no exception. I would say in terms of takeaways, there was still optimism. I know the last time I was at the MBA conference I think it was about the last conference we went to before COVID hit. And the narrative coming out of that conference was, just more blue sky, open space. And it was a little more managed this year, but there was still optimism. I think the first half of 22, everyone seems to be really optimistic about what's happening transaction-wise, origination-wise, opportunity-wise. Definitely some chatter about interest rates. That's definitely becoming part of the narrative and on everyone's radar. I don't think it really tampered down the optimism, although it is something that was discussed. And the other takeaway was the ESG component. So they had at least one panel that was dedicated to ESG, with a lot of the large insurance companies and debt funds talking about, opportunities related to ESG and some of the underwriting requirements that they're having to incorporate. So it's really interesting. I think we've gotten to the point now where instead of asking what inning are we in, now it's, what are your strategies for ESG? And it's similar in terms of ambiguity on the answer. We all agree, or the lenders would agree, that ESG is a real thing that has to be, calculated into their underwriting, but nobody's really sure what that truly means. And there's really not a set of uniform standards. So overall, great conference. Always good to be in San Diego. Got to meet and see a lot of people we hadn't seen in a couple of years face to face, which is always great. And it's good to see that there's still optimism in the marketplace, even with some of these things we hit on the intro here today.
I mean, how could there not be, when you think about it, that when you see the velocity of transactions and the size of the transactions, and that every one of these sales comes with, a big mortgage that's being refinanced and new lending coming in, I think that these guys have to be thinking, now that we're a month and a half in, this is just going to be an extraordinary year of volume. I came out 2 months ago when I was asked to submit my numbers for, a poll for what CMBS issuance would be in 2022. And I think last year for like SASB and conduits, I think we were 110 billion, another 50 billion in CRE CLOs for a total of 160. And I put out a number for the conduit SASB space of 130. A 20% increase is going to feel pretty good. And now I think I might miss that by half. Like, I could see us being 180 billion of conduit and SASB in 2022, just based on the fact that every day you're seeing 20, 30, 40 deals getting done, transaction sales north of 25 million in value. And some of these things are billions, right? Portfolio buys by Blackstone or Brookfield or others, right? Sometimes you see enormous ones, but the velocity is like nothing I've seen since like 2006, 2007. And, I think that guy that pulled up in the Ford Explorer this year is coming back next year with a Porsche.
Well, it's not just the transactions, man. As you look at some of these earnings from the hotel groups, so we all know the bottom fell out on those when COVID hit, but Hilton, they met their earnings estimates, beat revenue forecasts. Occupancy rose to 63%, which was up from 21% a year ago in the same period. Comparable revenue per room, or RevPAR, increased 104% in the fourth quarter. So, I mean, Hilton seems to be knocking it out of the park. Hyatt Hotels was far worse than feared loss in the fourth quarter, so they've kind of turned it around. We have information on Choice. RevPAR was up. Wyndham revenue soared 32% to $392 million. So, for all the things you just said on the food groups or asset classes that we would expect to be excelling during this time, even the hotels are starting to roar back a little bit, which I think bodes well for those origination numbers.
You probably saw the deal this week where Wynn did a sale leaseback of the big casino in Boston, the Encore, I think it's called. It's just outside of Boston, more than 2,000 rooms. Wynn sold it for $1.7 billion, and they will pay $100 million in rent per year, which turns out to be an effective rate on that $1.7 billion of 5.88%. But goodness, we're back, aren't we?
Yeah, if we went back and looked at the first couple of SASB deals that priced out right after the pandemic with hotels, I remember you and Joe talking about, some of the carve outs and caveats and things that had to go back into those deals to get them across the finish line. And this just shows the market's fully recovered, at least perception. And based on these few large, Blackstone had one in Las Vegas a few weeks ago. It seems like we're back and maybe even ahead of where we were before.
Yeah, for that Wynn deal, just to close the loop, $835,000 per room, and the buyer was Realty Income Corp, $1.7 billion. So, we're back.
One other earnings note was Airbnb. They beat Wall Street estimates on earnings and revenue in their fourth quarter, and their outlook looks really good because obviously they are a beneficiary of the work from home or work from anywhere type of business. So they said nearly half of all nights booked in the fourth quarter were for stays of a week or longer, and 1 in 5 were for stays of a month or more. So people are picking up their laptop and going to the beach or the mountains and working remotely rather than having to stay in their domicile, wherever that might be.
Well, it's like that line from the Lego movie, everything is awesome, right? That they were singing, or everybody is awesome, or something like that. The catchy jingle that was right at the beginning. And it is a little hard to believe, right? That Airbnb and all the hotels are just blowing away estimates. You would think that there would be winners and losers. Airbnb would be taking away some share from the hotels, or perhaps Airbnb wouldn't be growing as fast as the hotels were coming back, or something. But everything is awesome, right? Casinos are being sold for huge prices. Hotels are being sold for close to what their values were in 2019, sometimes surpassing them. RevPAR is up, bookings are up, occupancy is up, and Airbnb is up. So it just goes back to this narrative that we're back and the economy is humming.
Yeah, Airbnb, short-term rental, just another anecdotal Twitter story. If you look at the term STR online, you're going to be blown away with what these people are actually getting on a monthly basis in revenue. So just in real terms, you have a single family home you're renting out on a long-term lease, $2,500 a month. It probably produces $9,000 a month if you turn it into a short-term rental. So the economics on that are just crazy. So, there's a story we picked up here. New York-based investment firm Salutagrade, they're launching a venture with short-term rental operator Avant Stay to buy $500 million worth of homes. The company stated this last week. Salutagrade says they're going to raise debt by selling mortgage bonds backed by its homes to investors. And effectively, they're trying to create the first vacation rental mortgage security. So in this instance, the Avant Stay CEO, Sean Bruner, said the vacation rental sector will follow a route similar to that of single-family rental homes, which have attracted a surge in investment from private equity firms and other financial firms over the past decade. So everything you just said, Manus and Martha both, I mean, I think this is the new track for yield. It'll be interesting to see if this investment venture can play out to the same tune of Airbnb and some of these other short-term rental operators.
They just can't call it timeshare, right? That has such a negative connotation.
Yeah, that's bad.
They have to come up with a more modern, less tainted name for that particular offering that they're going to do. But, what we saw in the single family rental market is, what that does is it takes houses off the market and drives prices up, right? It reduces inventory of single family homes, particularly those under 500,000 or in some markets under 300,000. So it makes buying a home a harder or more difficult endeavor and a more costly endeavor for families just starting out. And what you may see here, depending on what these guys end up doing with this new venture, if they start taking apartments off the market that would otherwise go to, middle class, upper middle class, and use those for, month to month or week to week housing, Airbnb style, what that would do is drive the price up of multifamily housing, right? If that's the model and you're taking, 1,000, 2,000, 3,000 units off in each of the top 50 metros, well, that's just going to drive the cost up. And that's good for them for coming up with some, a new way to profit from it, but not a good thing for families just starting out, people on the lower end of the economic spectrum. And, I hope supply can keep up with whatever demand is taken off the market.
Yeah, I was talking to a guy this week that's looking at some property up in Colorado, like in the Breckenridge area. And to answer your question there, man, it's they don't call them timeshares anymore. They call them equity shares. So you get a 1/8 equity share. It sounds a little more institutionalized.
Yeah, I don't know. I don't think it's too name adjacent for me. I think they should have called it Blue Skies or something.
So turning to shoutouts, we have a podcast fan put forward by Susie, who's commented several times in the last few weeks. Omar B is a big fan of the podcast and mentioned to Susie that listens very frequently. Black Eagle commented on our Lauren Thomas episode. She said it was a great episode and watching pricing for Peloton and malls. So thank you. Ann L on LinkedIn is a fan. Interesting, fact-based, lively, and entertaining. It must be the rapping that Lonnie does that she was referring to. And we had a couple of folks that commented on our Twitter poll on favorite Super Bowl food after our chili cheesecake comment last week. So I think chicken wings and nachos won. And last and certainly not least, Dave and Tammy Goldfisher from the Henley Group. They were our first podcast guests. They were out at MBA and stopped and talked to our team and apparently had very nice things to say about you, Manus.
Well, that's great to hear. They're lovely people and they do bring a great service to this market, helping people navigate the restructuring process, really knowledgeable about CMBS lending, the role that special servicers play and so forth. So I wish I had been out in San Diego to see them because they're great people. I have a couple of shout outs here, which might fall into the category of the height of lack of consideration. I do owe data and responses to both Joel and Deborah. Joel had some questions about our hotel losses, and Deborah had some questions about mall losses in the past. And how's that for lack of consideration? I forgot to send them emails back, letting them know that I still remembered that I have things to do for them. Instead, I'm telling them via the podcast, so they have to listen to find out that I've been dragging my feet.
And of course, for many of us, Monday is a holiday, so it'll be a short week. So, I'm a bit of a grammarian geek. So I noted that President's Day, strangely, is spelled President's Day, no apostrophes, President's Day with an apostrophe, and President's Day after the S apostrophe. So I think it's up to interpretation whether you think we're celebrating one president or several, and it belongs to them.
Well, Martha, I am a man of little words. And to be clear, I'm not a man of few words, I'm a man of little words. 2 syllables or less. So if you're looking to me for help on this particular subject, I think you have to go back elsewhere, looking for that Elements of Style book that you grew up with.
I had that, see?
There you go. You get up to word like president with 3 syllables. and you're kind of outside my sweet spot.
You're beyond your abilities.
Oh, well, I've put together a few slide decks over the last couple of weeks. So I just want to confirm that Martha does have a really good eye for finding those grammatical mistakes. She's a really good proofreader, and it's pointed out that I maybe have some deficiencies when it comes to where the apostrophes are supposed to go.
And any talent works in this economy. So with that, we'll close. Thank you to our producer, Haley Keene. Join us next week as we look at what's happened during the week and how it may be impacting. If you have a question or comment, send an email to podcast@trepp.com and subscribe to the podcast with your favorite provider. Enjoy your day off, guys. Thank you for listening and stay well.
All right.